Welcome back to the deep dive. Okay, so you shared some research, pretty compelling stuff actually, outlining this potentially hyper-aggressive pass for Bitcoin. We're talking maybe $170,000 or even higher.
That's the number floating around, yeah.
But the kicker seems to be the timeline. The real focus is like right now, the next 3 months.
Oh, it's urgent.
And just for context, we're recording this on October 1st. Bitcoin's right around $118,000 today. That price, 118K, that's kind of our anchor point for understanding these huge investor moves, right?
Absolutely. And look, we're not just talking a gentle slope upwards. The sources suggest a potential parabolic move, the kind that often caps off a bull cycle.
Right.
So our mission today is to really dig into the two big forces supposedly driving this. First, there's this massive global liquidity easing macro stuff. And second, something weirdly structural happening on-chain, like who actually holds the Bitcoin right now? But importantly, we've got to be critical. We need to weigh this bullish story against some, frankly, quite serious historical red flags. Because the data inside the Bitcoin network, it's really conflicted right now.
Got it. Okay, let's unpack it. Starting with maybe the biggest player on the field, central banks. The Fed just moved, didn't they? Cut U.S. rates down to 4%.
They did. And that's huge.
I mean, the Fed is the global central bank, basically.
Yeah. Controls
Controls the dollar supply, over $7 trillion in assets. So how does a small rate cut translate into, like, rocket fuel for Bitcoin?
Well, it's a direct liquidity tap. When the Fed cuts rates, borrowing money gets cheaper. Simple as that.
Okay.
That encourages banks to lend more, pumps more money into the system. Basically, it boosts global liquidity, just the amount of spare cash, sloshing around.
Right. And we saw the opposite happen back in 2022.
Exactly. Perfect reverse example. The U.S. M2 money supply, that's your cash, checking, easy access savings, it dropped sharply right alongside the Fed's rate hikes.
Okay, so M2 shrinks when they hike.
Mm-hmm.
It makes sense. It expands when they cut. And the sources showed M2 only really bottomed out and started climbing again after the Fed paused and then started cutting back in, August 2023?
Precisely. And the power isn't just the Fed acting alone. This is coordinated. We're seeing a global wave of easing.
How big a wave?
Get this, 88 rate cuts from central banks around the world in just the last 8 months. That kind of coordinated easing pace, we've only really seen that before during massive liquidity pushes like back in 2020.
Wow. Okay, so the central banks are basically putting their collective foot back on the accelerator.
That's a good way to put it.
Now, Bitcoin's sensitivity to this, we hear about it all the time. How sensitive is it, really?
Think of it like this.
Sure.
If the macroeconomy is the ocean, Bitcoin isn't just a boat, it's maybe the speedboat. The data points to an 83% directional alignment with global liquidity.
83%.
Yep. So when liquidity goes up, Bitcoin follows overwhelmingly. And just for comparison, the S&P 500 is strong too at 81%, but gold's much lower, around 68%.
So Bitcoin is the most sensitive major asset.
To this global flood of money, yes. When the
Okay.
tide comes in, Bitcoin tends to, surge the most dramatically.
Okay, that definitely makes a $170,000 target sound plausible, at least from a liquidity perspective. But here's the but. We have to be critical, right? The big bearish argument hanging over everything. History.
Mm-hmm. The recession risk.
Yeah. Since, 1954, almost every time the Fed cut rates like this, it was either just before or right smack in the middle of a nasty recession. And recessions are usually terrible for risk assets, right?
It's absolutely a critical point to consider. And we are seeing some warning signs now. The labor market, which was holding up so strong, it's definitely showing cracks.
How so?
Well, we got a pretty clear signal back in June 2025. The non-farm payrolls report actually went negative. The economy lost jobs. Yeah, and if history's any guide, sustained job losses usually mean a recession is either already here or right around the corner.
Okay, that sounds genuinely worrying. So how can anyone still talk about a soft landing? Is there data arguing against hitting that historical breaking point?
There is, actually. While things are slowing down, we haven't hit those extreme stress levels you usually see before a really big contraction.
Like what?
Take the ratio of job openings to unemployed people. Right now, it's sitting at 1.0. Back in the 2001 and 2008 recessions, that ratio fell way below 0.8. So yes, it's cooling, but it's not the kind of deep freeze in the labor market we saw in past crashes.
Interesting. So less severe stress, maybe.
Hmm.
And is this just Wall Street data or?
No, it's backed up by Main Street, too. Look at the NFIB survey, that's the Small Business Sentiment Index.
Right.
It's showing a surprisingly constructive outlook. Small businesses are saying this is the best time to expand operations they've seen since 2020.
Since 2020, that sounds optimistic.
It is, and that's key. That kind of optimism usually pops up mid-cycle, not when you're heading into a downturn. Before past recessions, small businesses were getting really pessimistic.
Okay, so we have these two competing stories. History says rate cuts mean recession danger. But current data, like job ratios and small business sentiment, suggests maybe, just maybe, we dodge it this time.
Exactly.
So for that big $170 K target, it seems like the deciding factor boils down to when these cuts are happening relative to the economy's health.
Precisely. Look at the stock market's history. Bitcoin tends to follow its general direction in macro terms. When Fed cuts happen outside of a recession, stocks rally typically around 15% in the next year.
Okay.
But if the cuts happen during a recession, stocks tend to fall maybe 10% on average.
So if the current data is right, and we avoid a full-blown recession,
Then the macro backdrop actually stays pretty constructive, even favorable for high beta assets like Bitcoin, assets that thrive on economic optimism and liquidity.
right, okay, so the big global picture seems cautiously green then, despite the historical warnings.
I'd say so, yeah. Leaning positive.
But if the macro winds are blowing so favorably, why isn't Bitcoin already flying higher? Why isn't it at $170 now? This must be where the internal on-chain stuff comes in. You mentioned conflict.
Huge conflict. This is where it gets really fascinating and frankly a bit confusing. You have major forces pulling in opposite directions inside the Bitcoin network itself. Who's selling versus who's buying?
All right, let's hear it. What's the scary part first?
Okay, the bearish signal. It comes from long-term holders, or LTHs. These are the folks who bought Bitcoin years ago, held through thick and
Hey,
thin.
diamond hands, basically.
Kinda, yeah. Well, these LTHs have been selling a lot. They've booked profits on about 3.27 million Bitcoin.
Wait, 3.7 million coins. At today's price, around 118K, that's just doing the math quickly, over $375 billion in profit-taking.
It's a staggering number. Absolutely massive. And here's the really worrying part. That level of LTH profit-taking, it actually surpasses the peaks we saw in the 2013 and 2021 bull runs.
Okay, hold on. If LTH selling is higher than at previous market tops, shouldn't we be bracing for impact? Historically, didn't that precede huge crashes like 75%, 85% drawdowns?
Yes. Historically, it absolutely would signal a major top and an imminent crash because back then, when the LTHs sold that heavily, there just weren't enough buyers, especially institutional ones, to soak up all that supply.
Ah, okay. So what's different this time? Who is buying?
That's the bullish countersignal, and it's unprecedented. The buyers are primarily Bitcoin treasury companies.
Meaning corporations putting Bitcoin on their balance sheets.
Exactly. These companies have massively increased their holdings. They went from holding around 300,000 coins in early 2025 to over 1 million tokens today.
1 million Bitcoin held by corporations. That's what percentage of the total supply is that?
It's almost 5%, a huge chunk.
Okay, so connecting the dots. This isn't just selling pressure or meeting weak demand. It's more like a changing of the guard.
Precisely. That's the core thesis here. A massive, rapid rotation in ownership. Coins are moving from those long-term, maybe more retail-focused holders taking profits directly onto the balance sheets of billion-dollar corporations.
And these corporations presumably have stronger hands, longer time horizons.
You'd assume so. This massive buying from institutions fundamentally changes the dynamic. It looks less like a classic market top, which usually involves fading demand, and much more like, well, like the groundwork being laid for a potential melt-up, an aggressive final push.
Okay, this rotation idea makes sense, and it brings us right back to the timing. Why these next 3 months, October, November, December? Why is this window supposedly so critical for hitting that 170K?
It comes down to historical cycle patterns, especially looking back at 2017.
Okay.
Back then, Bitcoin moved through 4 clear consolidation stages. The key thing is, that final consolidation stage ended right around September 2017, and what happened next?
The massive parabolic run.
A shocking 500% gain in just 3 months. That was a final explosive leg up.
And you're saying today's market structure looks similar, like we're in that 4th stage now.
If you overlay the current structure, which arguably began back in late 2022, yes, it looks remarkably similar. We seem to be pressing right up against the top of that 4th consolidation zone, right now, here in October.
So if that 2017 blueprint holds, we could be entering that final, most aggressive phase of the cycle, literally as we speak.
That's the idea. And there's other evidence suggesting Bitcoin is kind of spring-loaded here. It's been lagging, right?
Lagging what?
U.S. stocks. Since April 2025, U.S. equities have ripped higher, up almost 40%. Bitcoin, it hasn't kept pace at all.
And why is that divergence important?
Because the macro conditions, as we discussed, are still pretty good for stocks. Especially with Fed cuts outside a recession, remember, stocks are usually higher 70% of the time, 12 months later when markets are new highs.
Right.
So it suggests that the institutional money pouring into risk assets went into stocks first.
Mm-hmm.
But now Bitcoin looks overdue for a really strong, maybe even violent catch-up rally to close that performance gap.
Okay, catch-up potential. What else? We also have the U.S. dollar weakening quite a bit, don't we?
Massive tailwind. The dollar index is back to levels we last saw in early 2022.
And a weaker dollar is good for Bitcoin.
Historically, yes. Strongly aligns with the big BTC bull runs 2017-2020. It just makes global liquidity conditions easier and sometimes drives capital into non-sovereign assets like Bitcoin when the dollar looks less attractive. Even in 2017, there was a temporary dollar bounce, but it didn't stop Bitcoin's final parabolic move.
Gotcha. But the most compelling piece of evidence for the 170K target, according to the sources, was this valuation model. Something about undervaluation.
Yeah, this is quite striking. Based purely on the historical relationship between U.S. stocks and the U.S. dollar, the model suggests Bitcoin should have rallied about 150% over the last 6 months, given where those other markets are.
150%. But how much is it actually up since March?
Only about 35%.
Wow, okay. That's a huge gap between where it should be based on correlations and where it actually is.
Exactly. An immense valuation gap. And we've only seen a gap this wide twice before, late 2020 and early 2023.
And what happened then?
Both times, Bitcoin launched into an aggressive, very swift catch-up rally almost immediately after.
Okay, so let's pull it all together. You've got easing global liquidity. You've got this fundamental shift with corporations buying huge amounts. You've got the historical cycle timing pointing to an explosive final phase right now, and this glaring undervaluation signal.
That's the convergence. That combination is what provides the strong support for projecting a rapid move, maybe towards that $150,000 to $170,000 zone, potentially by year-end. The current $118,000 starts to look more like a launch pad than a ceiling.
It really paints a picture of the next 3 months being absolutely crucial.
It really seems like the window, yes, the macro lights have turned green, the historical cycle clock seems to be ticking into the final phase, and that big internal conflict, the LTH selling, it's being met and absorbed by unprecedented institutional demand. It really does set the stage.
All right, so let's quickly summarize this deep dive then. First, global central banks are pumping liquidity back into the system at a pace not seen since 2020. Big positive.
Check.
Second, while there are recessionary whispers, key data like the jobs market and small business outlook suggest we might avoid a full-blown crash, keeping the environment okay for risk assets.
Seems likely, yeah. Resilient enough.
And third, the historical cycle patterns, combined with this massive rotation of ownership towards corporations, strongly suggest we're entering that final, most aggressive phase of the bull run. Potentially right now.
That's the core thesis. And this institutional adoption really is the game changer compared to past cycles. It leads to a final thought for you, the listener, to really mull over. If this rotation holds, if Bitcoin is increasingly moving from maybe more flighty long-term individual holders onto stable corporate balance sheets, what does that mean long-term? What are the implications for Bitcoin's future volatility? Could it create a higher, more stable price floor? Does this shift signal a fundamentally different, maybe more mature market dynamic moving forward? Something to think about as these new large holders potentially start dictating more of the price action.